So, Attila, great to see you.
Good to see you too.
Yes, and reason I asked you for this video call is to kind of walk me through the digital due diligence landscape and also this tool that we have built. But before I dive into it, for all the watchers or anybody who's visiting this website or watching this video, shortly, my name is Christopher Voulade. I'm a founder of QLA. We're an advisor firm and also have our family office leg as well, which what we're building. But I think we met through LinkedIn, which is a great connection place, right? Somehow we found it connected. A couple of months in, we start talking, okay, where our strengths are. And who doesn't know Attila? Then Attila is founder or co-founder, actually, of Cognitive Graders, which is digital insights and digital due diligence kind of advisory company. I may tell me if I'm wrong here, but and then I also know that you are an author of a book that you just recently launched, like 6 months ago, and you did a promo for that, which is hyper. Yes, it's really good book. I've started reading it, and life gets in between. But I promised you that I'm gonna finish this before the end of the summer, because I want to get better at marketing and branding, which I think is super important. And a lot of people don't know this about you, that you're were a professional athlete, a cyclist as well, and even a national champion in cross country. That one I know about you. But just curious, how did you end up doing this? How did you end up doing? You're a digital due diligence expert. You're great in technology. You're great in branding, marketing, everything. You understand numbers. How did you end up doing this? And what's the story?
Okay, I will try to keep it short. So honestly, it's serendipity, and I have to be grateful for my father. So actually, it's connected to cycling. When I was 17, really into the national and also international championships. That was my whole thing, my whole focus. And my family was basically my only sponsor. And I don't come from a rich upbringing, so I really appreciated that I could go to races. I had a bike. I had basically everything I needed to prepare and race on a national level. And one summer, my father comes to me and says, "Yeah, I'm launching a new business that I want to have a web shop." I'm like, "Okay, what's the point?" And he says, like, "Well, you are in high school learning IT and mathematics, right?" I say, "Yes." "Well, then just try to do the web shop." Like, okay. In reality, in high school, we learn really basic principles, nothing close to web or any advanced software development. So I was like, okay, I need to learn this thing. So over the summer, I spent my time on Google, YouTube, as friends, other family members, and I made the web shop happen. Nothing fancy, nothing like Amazon. It was just really simple web shop. And I gave the access to my father, and I completely forgot about it. And then a couple of months in the autumn, I think it was either end of October or November, it was really a heavy rain. I still remember the day my father comes to my room and says, "We made the first sale." I'm like, "We? Where? What?" And he says, "Well, on the web shop you built." I was like, okay. So this was not just an excruciating summer assignment. It's actually creating value. And as a teenager, it's like, okay, I'm into something. I don't know what or why, but it started me thinking, okay, why just one sale? So I realized there's no way to track what's happening on the website. I didn't have any software to track visitors, what they are clicking, what they are doing. Said, okay, I need to learn a bit about data analytics. Then I realized, okay, but I don't know, even if I would see the numbers, I don't understand the behavior. So I need to learn about consumer behavior. I need to learn about user experience. So this is how it all started. A long time ago. And today my focus is on advising corporate management boards, investors, private equity investors, family offices, how to look at companies in terms of the digital perspective. Because most companies, when they are raising or they are part of an M&A, are basically audited financially and legally. And 90% of the time, the digital part goes under the radar. And 90% of the time, that's a huge mistake, which is costing millions of dollars and pounds, which basically the investors take as a hit, and it erodes the ROI. So it's actually better to see these things upfront than to see the skeletons in the closet later. Long
Makes
story
sense.
short, that's my journey. In between, it was with lots of ups and downs, but this is how it started, and this is where I am today.
Very cool. Very cool. Hell of a story. Becoming going from sports to doing private equity, FO, family office, verticals, etc. Investments. Totally different game, right? Than digital marketing in that sense. What do you think? Just in general, there's a lot of technology companies that have strong brands, but the majority of the family office investments are still, I may be wrong here as well, but still some statistics say that are reporting from Big Four or whatever say that the majority of assets have been, the real assets, industrial, manufacturing, etc. And when a company is trying to acquire or sell, a factory or a fleet of ships, let's say, where's the digital aspect there?
Let's go to ships, because I think this is a really good one. And this is actually a true story. So one investment went completely wrong around ships, cruisers. So these big ships that go over the Atlantic and take hundreds or maybe thousands of people. I'm not a ship guy, so I don't exactly know the ship specifics. But what I do know is that the investors bought basically a set of cruiser ships, secondhand, and the ships were checked physically, like their proper condition, and relevant ship service company did the checking. Of course, there were issues here and there, but nothing serious. But what wasn't checked, how the ship's software communicate with the ship's basically engine, drives, sensors. And basically in technology, you have usually two components, the software component and the hardware component. And if the hardware component is not communicating with the software component, then you are in trouble. So just to give you an analogy, when you drive a car and you see something blinking, like it could be that your windscreen wiper fluid is out, right? So you need to refill it, or your fuel is low, so you need to refill. This is also how ships are built. Like they have these dashboards, they have these signs which signal different things. And then ships, again, I'm not a ship guy, but for a couple of years, a a topic called predictive maintenance became very important, specifically for those ships which do really long routes, because you don't want a ship to stop in the middle of Atlantic, right? Because it's really expensive to service it out on the ocean. And this is actually what happened. One of the ships stopped. And it was not sinking or anything, but just couldn't go in the normal cruising speed. It had to go like in this limping, really slow speed. And it was, of course, an issue for all the tourists. And the reason, which later was detected, was that one of the drives didn't send the data to the software, to the dashboard. So actually, one of the drives had an issue. The hardware has a little algorithm called the firmware, and the firmware collects the data and basically is responsible to communicating with the software. And that data never ended up on the dashboard, so on the deck. So people, when basically started the journey, thought everything was okay with the ship. You could imagine the cost of servicing a large cruiser ship in the middle of the Atlantic. And I don't know whether it's good weather or bad weather, but imagine if it's a storm. Yeah, you can imagine it's not a pleasant situation, neither for the investors, neither for the tourists. So it's also reputation and fallout. There are a couple of things that basically create a negative impact. And I'm just sharing this story because these are the things that can be avoided if you do a proper digital due diligence, which, as you said, focuses on brand marketing, but really importantly also on the technology part of a company. And many people think, yeah, we are investing in infrastructure, or we're investing in ships or chemical companies, which don't have a digital leg. And that's completely wrong. Today, it's, I would say, most companies use some kind of hardware software technology. Whether they know it's a priority or not, that's a different thing, but it's in their operations. And as an investor, if you don't know what kind of disruption can be caused because something goes wrong, basically it can cost you a lot of money.
That makes sense. I mean, recently I had a chat with one person who has been in the shipping industry as well, and he basically finances the shipping and all the logistics and everything from bigger banks and institutions. So I asked him, what's the typical mistakes that people make, and they overestimate or underestimate the costs of what what it actually takes to move the cargo. But it is a good point that you pointed out. I'll come back to this more this technology angle as well. A lot of startups emerging, a lot of VC. I think I've talked with a couple of VCs as well. They think VC is broken. The traditional way of venture capital investing and VC funds or the structuring, it's kind of changing. There's a lot of SPVs, a lot of secondaries happening, private deals. They're kind of, some bigger players like Sequoia and others are moving into more the private equity side of things as well. Which they've publicly reported, but like makes it super difficult for a startup to have a strong, especially with the coming of AI as well. And I think it's on the growth trajectory. And when we were in UK in one event as well, there was one guy who said the growth of the AI, like what people are thinking, is gonna emerge even, like it's gonna scale like crazy. We're already seeing AI bots and those AI agents and etc. So for a startup, so my question is, for a startup, how can it be that they can actually understand whether they're in a good position to fundraise, whether they have a good brand, traction, etc., even if they have paying clients, even if they have users that they're using the product, they have good feedback and everything, and maybe they have solid investors in the cap table. So what's your thoughts on this?
Yeah, well, I think specifically everything below Series A is in bad shape in sense of, and I don't want to sound rude or aggressive here, but I saw this so many times that the ego of the founders gets in the way. Like, yeah, we have this super cool tool. We are growing like crazy. So we basically neglect really basic principles of brand marketing and sales development. And initially, until you're like pre-Series A, if you're already growing, having traction, most days that's almost a rare thing, right? So many startups are just trying to build that traction, trying to find investors. I'm talking about everything before Series A. And if a VC or a PE or even a private investor sees the traction, it's like, okay, they're already better than 80% of the market, so they should be good. And they can be good, but the risk is that they don't focus on the things that matter in time. And just to give you an example, if you're a startup and you don't build content around your brand, and let's say you are having traction, you're growing, let's say you got $500,000 in investment, and things look good. But what happens when a guy in a different continent starts doing the same thing like you do, but has a better network, and instead of getting 500,000, he gets 20 million? Basically, you are doing the same thing, but he has more money. Now, if you build the proper things in terms of brand and marketing and sales, then you have a shot. But otherwise, you're just washed out on the market. You were too slow, in the wrong place, wrong time, not enough investment, and you just wasted maybe 3 years of your life, and you have to start over. And this happens so many times, but of course, the internet is full of the success stories. But you probably could fill thousands of books.
LinkedIn
yeah. Yeah, LinkedIn. But not only LinkedIn, everybody likes to focus on the positive, right? TechCrunch or other other sites as well. So most of the startups don't know what to do, how to do it. And the even worst thing is that they don't even have the budget. So, for example, what we do at Cognitive Creators, it's not cheap. And we usually work with investors who invest in Series B or above, or if we look at the traditional sector, who invest in hotels, who invest in bigger things worth of north of 50 million, but even higher, because on a small scale, these guys don't have the money and can't afford it. So yeah, they have many challenges.
Yeah, well, it's a tough spot anyways, but so could you shed light a bit? So we built this tool, right, for assess for the and could you give I can also give a glimpse of how we kind of partnered up as well, but maybe you want to share from your side, and why did we build this tool for the startups then? What's the reason behind it?
Yeah, so I think Cognitive and QLA has a really strong partnership. We have different strengths, and we basically can give the kind of know-how and service in this partnership in a way like nobody else can. And that's, I think, why we started on LinkedIn, but then it was usually it's vice versa. You meet at an event and then you follow up online. we started online and then follow up in the real life in London. But long story short, and now the focus is on startups, and why we built this too and how we built it is to basically help them. So everybody who is pre-series A, so from pre-seed, seed, smaller startups, need a guide. They can't afford digital due diligence advisory. So we were thinking, okay, what is a way to support them that's scalable, that's meaningful for them, and that gives them kind of a neutral perspective of where their startup is in terms of branding, marketing technology, and it's benchmarked against our internal know-how, which is from over 20 plus countries, over 15 industries. So when they look at their results, I'm not saying it's perfect, but it's definitely neutral, and it's not biased. They can say, okay, these are our strengths, these are our weaknesses, and now I know. And if I'm a smart founder, I put away my ego and say, okay, I need to invest time and money into these sections if I want to be on the market in the next 3 years. Or you can take the risk and say, yeah, that's it. And if somebody does it better, it will happen. But it's for specifically if you're fundraising and you can tell the investors, like, we have a scoring, we know our weaknesses, we know our strengths. We actually need part of your money to fix some of these weaknesses. Then it makes more sense. Like, investors want to make money. They don't want to lose money. And especially nowadays in the current macro circumstances, I think reality hit many people in a way, like they thought like investors' money is free money. It's not free money. It used to feel like free money 5 years ago. But I think that this reality check actually is useful and helpful for the global business environment, because just wasting millions, it doesn't make any sense, right? It doesn't create more jobs. It's actually a waste of money. So yeah, but long story short, we've built this tool. It's for startups in the sense startup can use it. It doesn't cost hundreds of thousands of euros, so it's affordable. It's fast, so a founder with a CMO can use the tool, spend around 60 minutes and have their results. And then it's comparable. Like, they can do this benchmarking and come back 6 months, 1 year later, do it again and see the differences. So yeah.
So a question then. There are so many reportings and audits and everything that you can do. You can always go do some kind of Big Four, or even maybe startups don't go to Big Four or Big Three, but maybe they have an analyst or an expert that can analyze their things, or they have some kind of marketing audit done by a marketing agency, right? What's the number one thing? How this is different from other things? What differentiates this tool, this benchmarking, from kind of any other audit? You already brought out some of the things, but what do you think? What's the number one thing? How it's different?
I think that the number one thing, there is no upsell after it. So if you go to a marketing agency, like, can you check our startup branding and how things look? They will sure have a biased report saying, these are the bad things, and if you spend 100K, we can fix this for you. With this tool, we don't want to sell you anything afterwards. It's kind of like a tool for founders, CMOs. Whether you use the insights and then you go to your agency or your accelerator and seek help, that's your decision. but neither QLA or cognitive creators will try to sell any services. So it's unbiased, it's neutral. And as I said, it's benchmarked. So over 20 countries, over 15 industries. Even if you work with, let's say, a mid-level agency, that's quite rare that they would have so much data and so much benchmarking. It's possible if you work with a big agency like WPP or Ogilvy or the big guys, right? They have the data. But if you work with them, you're likely spending 500,000 minimum. And as a startup, it doesn't really make sense to work with them. At least not in the seed to Series A stage.
Just curious here. I did test myself as well. I got some report, the initial things. I shared them with you, and I was like, God damn, it's better than I expected, and it's more worse than I expected. So I'm like, I think I kind of, I'm not like a branding expert or anything, but I think I have and I'm not a startup as well per se, just building any technology per se. So, I was looking at the report and I'm like, God, what do I need to do? So, like, let's say a startup gets the results, right? They do the test,
Yeah.
they get the neutral benchmarking, everything. What's the best way they can utilize it? What they can expect from this, and what's the the thing here?
So it's not yet official. It will be first said in this video. But for the first 100 startups, we will have a 30-minute session to go through their numbers and basically guide them. So this is a limited offer. So if you're watching this video and you don't see it on our websites, you're too late to the party. So act soon. But for the first 100, we will give this guidance. For those who were left out from this, I really advise them to talk with an agency, but based on the KPIs, because you used the tool, you found your results, you see they are basically scored, so you can already understand, as you said, even if you're not a branding expert, you had an expectation of your own brand, and then it turned out to be slightly different, some way better, some way worse. And that's the goal, to give this neutral feedback, and then go to somebody who can help you either on the branding or the marketing side. And probably in some cases, there's a person in the accelerator or a person already in your investors or in your board of advisors that can guide you, but at least you have like a transparent picture where you are.
So, to my understanding, I'll get a picture, which I did as well, but the startup, they get a picture what's going on, benchmarked, and then if they are early, they can also get this bonus, basically, that your advisors, or maybe even you, who knows, will.
Who knows? if they pick the right date, I might be the guy. We'll see.
Got it. Very cool. Very cool. So last question about this tool, and then maybe you share at the very end what's the bigger picture, and if they grow, and what should they, kind of why should they come to you, basically, or vice versa. But the last question is kind of what I was thinking when I was filling this out. Should every startup do it? And if no, why? And then what kind of startups should, or even, earlier stage companies, SMEs even, why they should consider this?
Yeah. The short answer, no, not every startup should do it. First, Series A or above, it's not enough, not deep enough, not relevant enough. They can do it, but it's not for them. It's for the smaller guys. Also, there's limitations on the small ones. If you're idea stage, it's not worth for you to invest that money. It's not hundreds of thousands of euros, but still, it has a price, and an idea stage, it's not worth to invest it. So you should be a startup who has at least working MVP, has the first couple of clients, has some traction. It doesn't have to be big, but you have to have something concrete, a product, not a service, something that's functional. Even if it's not perfect, you sold it and it's working. For all those startups who didn't reach the stage, I wouldn't recommend using the tool. Probably it's a waste of money at that stage. Reach the first clients, have the MVP running, and then use the tool. And again, once you reached Series A or above that, then is the time to reach out to Chris or myself to see where we can help you in the next stage, because then the deeper type of digital due diligence creates more value, makes more sense, both for the founders and, more importantly, for the investors.
Yeah, makes sense. It's interesting because I'm seeing so many decks, and some of them are pre-IPO and Series A and B and onwards, and there's real things going on. But still, you kind of have a hunch on something, and you're looking the numbers and everything. You're like, what's going on here, right? But
Yeah.
To attract the investors' money, you always want to look more beautiful. But I think in nowadays world, being real instead of having a nice fairy tale. Of course, you gotta have a strong narrative and a strong story to be presentable, have charismatic, company story and everything as well. But I think this real stuff is, realism. This is what kind of helps to sell for investors or attract the capital as well. So I think we went a bit over time with this as well. I am sincerely thankful, Attila, for sharing this, for explaining this. And hey, anyone who is watching this video, thanks for taking the time. And down below there is links if you wanna, try do the test, do the assessment, and have a neutral kind of perspective or where the company is at. Yeah. Thanks, Attila. Yeah.
Thanks, Chris. It was a pleasure. And yeah. First 100 startups, remember, you have the 30-minute session. Be fast.
Very cool. Very cool. Thanks. Cheers.
Cheers.